Avinash Gorakshakar is Director of Research at Profitmart Securities, joining us on the show.
I think as far as Britannia numbers are concerned, the commentary may have been slightly better, but if you look at the numbers, nothing so exciting in the sense that one could expect a very significant amount of re-rating. We still believe that urban markets as well as rural market demand is still pretty soft. And I think the management has reiterated that possibly, coming quarter or maybe the next couple of quarters, we could see some sort of green shoots on the rural market side. So that is definitely a big positive because that could actually, increase the volume growth. But I think overall numbers were not exciting at all. In fact, in terms of valuations, I don't think, there's any hurry from our side to actually go and recommend the stock. We would prefer to wait for a correction. As far as Nestle is concerned, again, the street was expecting a very stellar set of numbers, but what has come out is below the market expectations. So I think despite the fact that numbers have been good on the face of it, what kind of volume growth and what kind of growth trajectory the management points out in the coming quarters is very important. I would still be a little wary because, these are expensive stocks. In fact, Nestle is also not trading cheap. Probably we'll wait for maybe some more clarity before we decide. But definitely in this entire earnings season, FMCG companies have been a kind of a very, soft kind of performer. You look at Hindustan Lever, you look at Dabur, Godrej Consumer. I think all these companies, they've not been able to capitalize on incremental demand, which still, from the rural pocket continues to be weak. So at best, we prefer a hold. I would not suggest any fresh buying, at least at these levels. I think, basically, AIH is an old player in the industry, and I think you've been right that numbers this quarter have been extremely strong. My sense is AIH has always been a kind of a player which has operated in the five-star and in the luxury segment, and I think that is one segment which has done remarkably well. They have also announced pretty good expansion plans to diversify into new markets. So I think EIH, despite the fact that it's run up significantly, I would still consider it as a medium to long-term investment, considering the fact that this growth trajectory is definitely going to be maintained. We believe the hospitality and the travel market continues to be buoyant. I think both in the domestic market as well as people who are coming from abroad, the foreign tourists. And this cycle is going to continue for the next 2 to 3 years because supply demand wise, supply constraints still continue. And I believe that major events like World Cup, G20 have actually boosted India's image. We believe that the current year should also be equally good. As far as Lemon Tree is concerned, see, they operate in the accommodation, which is preferred by the middle class and the lower middle class, kind of customers. Most of the hotels are affordable segments, and they've also announced a very massive expansion plan. So I think, on the leverage side also, if you look at Lemon Tree, they've been funding a large part of their growth from debt. So I think we have not seen the full benefit of this expansion coming out. And obviously, in the initial years, the occupancy level is going to be lower. The cost of funding is going to be high. So until they scale up, I think you're not going to see any remarkable risk-reward return on Lemon Tree. Although longer term, yes, they are definitely a formidable player. But these numbers to get better will take at least maybe 12 to 18 months before we see the benefit of the expansion getting reflected in the revenue and in the cash flows. Trent is one of those retail companies, where we believe the numbers have actually been very stellar and very robust. I would not be surprised that, considering the kind of, geographical network they have, the kind of product they cater and the kind of customers they have, I would not be surprised that even next year could be a very strong year for them. So I think, in these kind of companies, rather than taking a short-term call, if you've got the next 12, 18 months in mind, any correction should be used as an opportunity to buy. Any dip in the market for whatever reason should be used as an opportunity to add to your portfolio. Even investors who can buy now can expect a decent 15-20% upside over the next, say, 18-24 months. So this is a quality stock, again, a very top management, and most importantly, numbers which they have delivered actually shows the scalability kind of potential for this business. I think within the retail space, this has got the best opportunity to outperform. But I think you need to give in a little more time because the stock has moved up quite significantly. So I think it will consolidate for some time. But longer term, I think we could see further value upside from the current levels. I think Adani Green, my sense is, looking at the kind of opportunity in the solar space, Neeraj, what Modi ji has announced post the Ayodhya Ram Temple inauguration. I think clearly the government's focus on renewable and green energy is increasingly getting more and more stronger. And I think in that aspect, Adani Green definitely is a very dominant player. And I think, despite the fact that numbers have not come in, they have a large capacity to scale up. and that is something which the markets is quite positive. So I think now the markets are just playing on the narrative. I think numbers will follow very soon. As far as Hindalco is concerned, we still continue to believe that we would probably wait for another 1 or 2 quarters before we see very strong numbers coming in. The last quarter numbers were definitely good, no doubt about it. But I think clearly, globally, metal prices the way they are, my sense is that only sustainability of these prices would give us more comfort. So as of now, we are not very positive on the metal sector. We believe that more importantly, the capital goods or maybe the building product sector. These are sectors which are more interrelated to the infra space. Cement is also a very interesting opportunity. So there are many other choices which are available compared to metals. That see, this is a simple bounce back which has happened. A stock which has fallen by almost 50%. Bounce back is obviously quite natural, but I think the key question which markets want to know is that earlier they had given a narrative that possibly they would become EBITDA positive very soon. Now that obviously is going to be a little tricky because after February 29, when the Paytm wallet is off, that's going to obviously upset their revenue stream, their profitability. So I would say that a little more clarity needs to come beyond February 29th. In fact, there have been some reports that some solution might be worked out by RBI in the near term. So once the solution comes in and the markets is confident that this kind of a regulatory kind of compliance issue is handled properly by the company, at that point of time, I think it would be better to jump in because even as of now, there's a lot of uncertainty surrounding Paytm. So I think clearly it's better to wait and watch rather than making a call at this point of time. I think the banking system and the PSU banks have over the last 5 to 10 years completely transformed. The legacy assets, the non-performing assets which they had. I remember, banks like IDBI Bank and Indian Overseas Bank had got asset qualities of as high of 25%. Now today, it's a completely different story. The frontline banks like Canara Bank, Bank of Baroda, SBI, in fact, even PNB has done remarkably well in terms of numbers. So I would believe that there's definitely a large amount of scope to get further re-rating in this pocket because this pocket has still remained a little subdued if you compare to the other kind of sectors which have outperformed. My sense is that this may be a little slow and steady kind of sector, but it is a very important sector for the economy with a budget of almost 11 lakh crores outlined on the capital expenditure side. My sense is that banks would be getting definitely a lot of business both from corporate capex as well as government capex. And I think on the financial services side, many banks have diversified into other good businesses. So that actually will add to their bottom lines and their revenue numbers. So typically, somebody who's got a long-term vision of at least a couple of years, I would not be surprised that there's a lot of professionalism, there's a lot of accountability now which has come in the PSU banks, which earlier was not there. So SBI, despite slightly disappointing numbers, our sense is that asset quality, the loan book growth, the deposit growth, these variables were very strong. And I think there was some one-time provisioning which impacted the profitability. So I think investors who want to take a longer-term call can still look at PSU banks if they have at least a 18 to 24 month kind of timeline. Because as Indian economy grows, I think the banking system is bound to grow. In fact, Neeraj, we have been very positive on the real estate basket, and one company which is Anant from Gurgaon. We have been investing in this company long time back. The company came out with its Q3 numbers yesterday. Very strong set of numbers, despite the fact that post results, there has been some selling. But we believe that this year the profitability will be around 230, 240 crores compared to 150 crores last year. And I think the cherry on the pack is basically the data center business. The data center business is now getting scaled up to 21 megawatts. And we believe that this is going to be a very strong earnings trigger for the company because there are very few companies which have got a 300 megawatt installation capacity. So I think this is one company where I believe the real estate market, the real estate business will be the cash cow, but the data center business is the growth opportunity. So we are looking at a target price of around 375, 380. And the other company is a small specialty steel company recommended earlier, Kalyani Steels. Now, this is a company which caters largely to Bharat Forge's requirements. Very stellar set of numbers. The company should be posting earnings of almost 60 rupees in the current year and hopefully around 73, 74 for FY25. So, it is not a commodity play, a virtually debt-free balance sheet with 600 crores of cash and very strong ROE return on capital employed numbers. So I think here we could look at a target price of around 750, 800. It's moved up from 680 odd levels, but I still think, on any dip, it should be acquired and, added to your portfolio. So I think they've been delivering very strong numbers, and I think this is not a pure pharma play. It is like a pharma and FMCG kind of play where basically they operate on a fairly low asset kind of base. So my sense is that the kind of products which they have and the kind of scalability potential which they have, I think are in pockets where the pricing power is quite solid and where I think margins would continue to get better. As far as tomorrow's sell out by the promoters, it's a very marginal kind of stake sale. It does not make any impact, but if it does any impact on the negative side, I think investors should use this opportunity to accumulate the stock. We believe the next 2 years are going to be even more stronger for the company. So I think any decline in this stock, obviously anybody who's got a long-term kind of view can definitely look at adding it on any decline. Neeraj, if you look at the last 2 quarters, numbers have been pretty disappointing, and I think I still feel that at these valuations it appears slightly pricey. So I wouldn't like to buy the stock at the current odd levels, considering the fact that FY25 is also going to be a challenging year. Whatever recovery is going to happen, it is going to take off in FY26. And the current price is something which still looks pretty expensive. So I think within the chemical space, we would prefer something like an RT Industries or typically a auto ancillary company like Philips Carbon PCBL, which obviously makes carbon black, and is not a directly a specialty chemical company. But numbers here have been pretty stellar, and I think the markets have already rewarded the stock in terms of a re-rating. But going forward, looking at the kind of water treatment business which they have acquired, I think that is going to be the next trigger for growth. So I think RT Industries and PCBL, these could be better bets as compared to Navin.